Welcome back to Iron Financial, the explainer, where our entire mission is incredibly simple. We are here to help you cut through all the market weakness, identify true structural integrity, and forge a significantly stronger, more resilient portfolio. Look, right now the market is absolutely ruthless. There's really no other way to say it. We are dealing with an environment that is brutally punishing anything with a weak balance sheet. You've got these constantly evolving inflationary pressures, a wildly volatile rate environment, and it is aggressively stress testing every single asset out there. So today, we are putting a highly debated fintech asset through the ultimate stress test. We are looking closely at FinVolution Group. They trade on the New York Stock Exchange under the ticker FINV. We are going to break down their latest Q1 2026 earnings, drill deep into their SEC filings, and see if the foundation actually holds up when you apply extreme pressure to it.
Yeah, and I'm here to represent your portfolio's defense mechanisms. Because let's be real, in this market, you just can't blindly trust the blueprint management hands you. You really have to get down into the dirt and inspect the concrete yourself. We need to know, is this company actually building long-term shareholder value? Or is this just some beautifully painted facade masking deep structural fractures? Let's get to work and find out.
Let's drop the heavy raw material right on the table to kick off today's stress test. As of early May 2026, FinVolution is paying out a truly massive 7.8% dividend yield. Now, to really put the sheer weight of that number into perspective, you have to look at the size of the whole operation. The entire market capitalization of the company sits at roughly $551 million. That's it. When you have a market cap that relatively small and a yield that exceptionally large, it immediately forces you to look at the load-bearing pillars of the business. You simply do not accidentally yield 7.8% in a highly efficient market. The market is very clearly pricing in a massive amount of risk. Exactly. And that brings up the immediate million-dollar question. Is this a solid foundation, or are we looking at a classic yield trap? Look, any seasoned trader out there knows that a yield approaching 8% is usually the market's way of flashing a giant neon warning sign right in your face. It very often signals that the equity price has already collapsed because institutional investors just don't trust the durability of the cash flows. What happens is retail investors see that 8% payout and they immediately start counting their monthly income before they even bother to check the basement for water damage. But here is the brutal reality of the situation. You chase that 8% income, but if the structural integrity of the company fails, the stock price drops 40% and boom, you lose your principal. You're literally losing half your house just trying to collect a few extra pennies in rent. So my question going into this is FINV a durable asset that the market is just completely mispricing, or is this a structural trap specifically designed to catch yield-hungry retail investors before the bottom falls completely out? Well, to answer that, we have to meticulously break down their Q1 2026 revenue engine. And the numbers actually show a very specific dual-engine blueprint at work here. Over in the Chinese mainland, net revenue came in at 2.2 billion RMB. That is up 6.9% sequentially, meaning quarter over quarter, which shows some real short-term momentum and a steady, if maybe a bit grinding, domestic recovery. But you really have to look at the other side of the ledger to see the full picture. Their overseas market revenue hit 948.9 million RMB. Now, that is a massive 34.5% year-over-year surge when you compare this quarter directly to the same quarter last year. So they aren't just sitting there relying on their legacy domestic foundation. They are aggressively pouring concrete and building out a rapidly scaling international segment. Now, let's look at how that revenue mix actually drives bottom-line profitability. Total net revenues for the first quarter were a solid 3.2 billion RMB. Out of that massive number, the overseas business, while it is still technically the smaller pillar at just under 1 billion RMB, is doing some serious heavy lifting when it comes to leverage. Operating profit in the overseas markets reached 45.8 million RMB. That is an 87.7% year-over-year explosion in growth. This brilliantly illustrates their local excellence Global Outlook Plus strategy actually working in action. The overseas platform is proving its scalability, and it's rapidly expanding its operating margins. It is really becoming a true load-bearing secondary pillar for the whole company. Okay, the international growth is impressive. I will definitely give you that. But come on, you cannot build a skyscraper on a cracked domestic foundation. What is actually happening back in China? We all know what's going on in the broader Chinese macroeconomic environment right now. You have an ongoing massive property sector implosion, you've got a seriously battered consumer confidence index, and lingering shadows over domestic spending everywhere you look. If the core business degrades under that kind of macro weight, the international growth simply won't matter. It'll all come crashing down.
That's a fair concern. But the data suggests the core is not just stabilizing, it is actively holding weight. Management cited early signs of credit recovery in the Chinese mainland business, which actually supported a recovery in loan origination volume to 38.5 billion RMB for the quarter. That volume, that is the literal steel rebar of their entire operation. It proves that despite those intense, undeniable broader macroeconomic headwinds you just mentioned in China, FinVolution's proprietary credit risk assessment and their automated loan transaction processes are still churning out massive, tangible volume day in and day out.
All right, volume and revenue are great on a spreadsheet, sure, but let's pivot from operations to capital allocation. Because cash in the business is one thing, cash in the shareholder's pocket is an entirely different story. I want to see historical proof of structural integrity here. What is their actual track record of returning capital, rather than just riding current market hype? You know as well as I do, a lot of executives out there talk a really big game about shareholder value, but the second the market gets weak and the pressure drops, they hoard cash in the corporate treasury instead of reinforcing their own stock. That is a highly fair challenge. And honestly, their history brilliantly illustrates a rigid, ironclad capital discipline. They didn't just suddenly start buying back stock yesterday to manufacture some temporary floor under the price. Look at the rhythm we have here. We've got Program 1 way back in March 2018, Program 2 in March 2020, Program 3 in March 2022, Program 4 in March 2024, and now Program 5 in May 2026. This isn't random. This is a deliberate, highly methodical history of reinforcing the steel when the equity gets cheap. They have repeatedly, consistently stepped in to buy their own equity during times of extreme broad market weakness. And to really hammer home the scale of this commitment, we need to look at the total cumulative deployment over that time frame. From that first program in March 2018 all the way through March 31, 2026, FinVolution has deployed approximately $516.7 million to retire their American depository shares. Those are the U.S.-traded certificates that represent their foreign equity. I really want to let that sink in for a second. We established earlier that the entire current market cap of this company right now is roughly $551 million. Over the last 8 years, they have effectively bought back almost a full market cap's worth of equity. That is an absolutely astonishing level of structural reinforcement. Which brings us right to the newest structural reinforcement, just announced on May 25, 2026. The board authorized a fresh share repurchase program of up to $150 million, running from May 30, 2026, all the way through May 29, 2028. The CEO explicitly stated that, supported by what he called a rock-solid balance sheet, they continue to deeply believe in the underlying value of their own equity. And they have options here. They can execute these buys on the open market, meaning drip buying day to day to constantly support the price, or they can do it in block trades, which are massive privately negotiated transactions that don't shock the public exchanges. Either way, it is a massive $150 million pillar of support placed directly under the stock price for the next 2 full years. But listen, buybacks are really just one side of the capital return structure. Their dividend history tells the exact same highly disciplined story. We are looking at consecutive annual dividend increases every single year since 2020. They started at 17 cents in 2020, growing consistently year after year. It jumped 16.9% in 2024 and ultimately reached a payout of 30.6 cents per ADS for 2025, which was just paid out in May 2026. This is not some erratic, unpredictable capital allocation. This is 6 years of uninterrupted, compounding dividend growth. That right there is the very definition of ironclad capital discipline. Okay, fine. The cash returns are undeniable. I see the numbers. But a strong retail pitch doesn't always equal a fundamentally sound asset. Are the actual institutions buying this foundation? Is the so-called smart money holding this asset? Or are retail investors left carrying the heavy load while the big funds just sit on the sidelines eating popcorn? Because if the foundation is as rock solid as you say it is, the heavy machinery of Wall Street should be firmly parked right here on this site. Oh, the institutions are absolutely in the mix, and they are doing some serious heavy lifting. Let's rattle off the massive institutional ownership base we've got here. First up, you have Susquehanna International Group, acting as the lead anchor, holding a massive position worth nearly $159 million. Right behind them, you have the Vanguard Group, sitting on almost $50 million. Acadian Asset Management is holding another $49.4 million, followed closely by Causeway Capital and State Street. These aren't just amateur day traders we're talking about. Firms like Acadian, they are quantitative powerhouses. They use brutal algorithmic scrutiny to stress test these fundamentals, and their models clearly decided the concrete here is solid enough to stand on. The smart money is definitively pouring capital into this asset. Cracks in the armor, the 20F filing. Let's dig in. All right, the lead analyst just painted a really beautiful picture of the exterior. We've got high yields, massive buybacks, institutional backing, and surging international growth. It sounds great, but it is my job to grab a flashlight and inspect the dark corners of the basement. We are transitioning right now to a deep dive into the 20F regulatory filings. This is the annual report they filed with the SEC on April 29, 2026. This is where the slick marketing completely stops and the brutal legal reality begins. And let me tell you, there are some severe cracks in the armor here. The absolutely crucial point you have to understand is how you actually own this company. FinVolution operates using a variable interest entity, or VIE, structure. By definition, a VIE is a legal structure where an investor has a controlling interest through complex contractual arrangements, not through majority voting rights or actual tangible equity ownership. When you hit buy on the FINV ADR on the New York Stock Exchange, you are not buying a direct piece of the Chinese loan operation. You are buying something else entirely. Think of it like holding a contract to the profits of a house, but your name isn't actually anywhere on the deed. I want to read directly from the risk factors in their 20F filing because this is wild. Quote, "We are a Cayman Islands holding company with no equity ownership." Let me repeat that for the folks in the back. No equity ownership in the consolidated variable interest entities, end quote. This is the literal disconnect between the Cayman parent company, which is what you actually hold shares in, and the mainland operations generating all the cash. You do not hold direct or indirect equity interest in the subsidiaries that actually make the money. You hold paper in a Cayman Island shell company that is linked by a web of complex offshore contracts. And here's the seismic regulatory risk that comes attached to that exact structure. Reading again from the 20F. If the PRC government finds that the agreements that establish the structure for operating our business do not comply with PRC laws and regulations, we could be subject to severe penalties or be forced to relinquish our interests in those operations. Look, the Chinese government has immense, completely unchecked power to alter or invalidate these operating agreements at any time they see fit. We all remember the 2021 tech crackdown with companies like Alibaba and Didi. When Beijing decides it's time to rewrite the rules, they do not ask Wall Street for permission first. Multi-billion-dollar valuations can literally get vaporized overnight. If they challenge this VIE structure, the financial performance of the entire company, and your equity along with it, would be utterly decimated. This is a massive geopolitical fault line running right through the foundation of this investment. But honestly, it gets even more concerning when we look at how cash actually moves, or rather doesn't move, within this corporate structure. Zero. That is the exact amount of dividends or distributions made to the FinVolution Group parent company by its operating subsidiaries in 2023, 2024, and 2025. Zero upstream dividends. The parent company injected over 1.29 billion RMB down into the PRC subsidiaries via capital contributions over time, sure, but PRC law heavily restricts how cash flows back up and out. They have incredibly strict capital controls designed to protect their foreign exchange reserves, making it almost impossible to freely move cash across borders. So the cash is largely trapped down in the operational layer in mainland China. That makes funding those generous ADR dividends and buybacks a highly complex, very precarious offshore balancing act. Okay, I have to acknowledge those structural concerns. You hit the nail on the head. They are absolute, undeniable realities of investing in Chinese equities, and you simply cannot ignore the VIE risk. But it's not just regulatory risk we have to consider. There is significant operational risk, too, as they build out this new international wing. The 20F clearly states they operate in international markets where the credit infrastructure is at an early stage of development. What that practically means is they don't have centralized, highly reliable credit bureaus like an Equifax or an Experian to fall back on in places like Indonesia or the Philippines. And more importantly, they bear the credit risks for the majority of the loans funded by their institutional partners. If their AI and their big data fraud detection algorithms miscalculate, without that centralized data safety net, they are heavily on the hook for those defaults. Expanding internationally brings high reward, absolutely, but it inherently increases the structural load the company has to carry. All right, let's bring it all together for the final verdict on today's stress test. We are weighing undeniable, massive cash flow against some truly severe foundational risks. On the strength side of the ledger, we have surging international revenue pushing 34.5% growth. We've got a brand new $150 million buyback authorization, a staggering historical track record of retiring massive amounts of equity, and 6 consecutive years of uninterrupted dividend growth currently yielding right near 8%.
But on the weakness side, you have to remember you're buying into a Cayman holding company with zero direct equity in the underlying operational assets. You are relying entirely on a VIE structure that the PRC government could theoretically dismantle tomorrow morning if they wanted to, and you are dealing with a corporate flow of funds where exactly zero dividends were upstreamed from the subsidiaries to the parent over the last 3 straight years.
So the ultimate takeaway here isn't a question of whether FinVolution is making money. They clearly are, and they are returning it aggressively to shareholders. The real question is, how does this highly complex, highly stressed asset actually fit into your specific portfolio construction? Are the massive capital returns and that juicy 7.8% yield enough compensation to bear the heavy structural, geopolitical, and VIE risks? Only you can look at the blueprints and decide what kind of load your portfolio can handle. So ask yourself, when the next geopolitical earthquake hits the market, will this 8% yield be your portfolio's reinforced bunker, or will it be the very thing that pulls the whole structure under? Stay focused out there, do your own due diligence, and stay ironclad. Thanks for joining us for this explainer, and we'll see you on the next one.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.